everybody, Dana Sparks, broker of Maximum One Greater Atlanta Realtors, and today's contract tip is a continuation of the video series on the changes to the 2019 GAR, Georgia Association of Realtors, contract forms for 2019. I just said that. Anyway, today's tip has to do with the changes to the financing contingency exhibits. There were a lot of changes, relatively speaking, to these exhibits. So let's dive in. So the first one, as you know from watching the series, is that all of the form numbers are changed. So the first one I'm going to talk about is are the changes to the conventional loan contingency exhibit, which is now number F404. And in this loan contingency exhibit and the other ones, they made this change universally. And the change they did is it has to do with the loan denial letter. So if a buyer is terminating based on the financing contingency exhibit, you know they have to send the notice of termination prior to the time frame negotiated with the seller. That's that 21 days, 28 days, 30 days, whatever it is that the buyer and the seller negotiate. And they must send a loan denial letter. So they have to terminate within the time frame and they have to prove it. And the way they prove it is with a loan denial letter. Now, in the GAR contract, they do have 7 days after sending the notice of termination to provide this loan denial letter. Now, the loan denial letter may not be based on certain things. That has always been in there. For example, it had always been in there that the loan denial letter may not be based on the buyer lacking sufficient funds other than the amount of the loan to close. In other words, if the buyer doesn't have their down payment or closing costs, that doesn't meet the terms of the financing contingency, and so they cannot use the financing contingency as a means to terminate, or their earnest money will not be protected. They will default. The other thing the loan denial letter may not be based on, and again, this has been there, is it may not be based on the buyer having leased or sold their current property if that contingency was not already negotiated between the buyer and the seller. And then C, the buyer not having provided the lender in a timely fashion with all information required by the lender, the loan documentation information, Georgia wood infestation report, whatever it is that the lender needs. If the buyer drags his feet and doesn't provide it to the lender, again, he or she is not going to get the loan, but it doesn't satisfy the terms of the financing contingency. So that had already been in there. So what did they change? They added the word solely. So it now says, notwithstanding any provision to the contrary contained herein, the loan denial letter may not be based solely, or another word for that is only, on any of one of those things. So, for example, let's say a buyer terminates within the time frame, you get a loan denial letter, and that loan denial letter states 3 reasons. One of the reasons is buyer has insufficient income, now not cash to close, but overall income to support the amount of the credit requested. Another reason they put on there is the buyer has too much outstanding credit. In other words, already obligated to pay back others too many, so this lender isn't willing to risk their money for fear that this buyer may not buy them back. And then another reason on this loan denial letter is buyer lacking insufficient cash to close the loan. Well, my goodness, this makes things a little complicated because you have 2 reasons that would support the buyer meeting the terms of the financing contingency and getting the earnest money back. And you have 1 reason that supports the seller getting the earnest money as liquidated damages, because that 3rd reason isn't a reason that fulfills the financing contingency. So it makes things a little complicated. So GAR has cleared it up a little bit this year by saying that the letter can't be based only on one of those reasons. That if it was only on one of those reasons in order to not meet the financing contingency. Another thing that GAR added is they did add an additional reason to the reasons that the loan denial letter can't be based on in order for the buyer to meet the financing contingency. And what that is that the buyer, in addition to that list I just read, the loan denial letter may not be based solely on the buyer making purchases that adversely affect the buyer's debt to income ratio. So you buyers, once you go under contract, no more purchases till you're closed. So again, that change regarding the loan denial letter is throughout all of the financing contingency exhibits. Now, the other thing that GAR added to the 2019 conventional financing contingency exhibit is they added a paragraph about lender required repairs. So apparently we have been seeing on conventional loans a lot of lender required repairs that had not been negotiated financially, because typically those aren't on, those in the past hadn't been included in a conventional loan. So GAR has added a whole paragraph, paragraph 12, and it states, any repairs required by the lender to be completed and paid for by blank, and the buyer and the seller negotiate who's paying for these repairs, buyer or seller, prior to closing, provided such repairs do not exceed, and there's a fill in the blank for the dollar amount in total costs. So any repairs required by the lender to be completed and paid for by blank prior to closing, provided such repairs do not exceed blank amount of dollars in total costs. In the event the anticipated costs exceed the amount listed above, an itemized estimate shall be provided to all parties from a third-party contractor or contractor selected by the seller of the total cost of repairs to be made by the property. Then the seller or the buyer shall have the option to pay the excess amount. If the parties do not agree in writing who shall pay the excess amount, then the agreement shall terminate within 3 days of the written notice of the itemized estimate. So that's a brand new addition to the conventional. Now, to the FHA loan exhibit, the only changes to the FHA loan exhibit have to do with those changes to the loan denial letter. Now, the VA loan exhibit, there are some changes to the VA loan exhibit. The first thing that they added is that same paragraph about the repair costs. So it's already been in there that if the VA, if the lender requires, if the VA appraiser requires mandated repairs, there's a place already in there for the buyer and the buyer and seller to negotiate how much that is. But here's the new paragraph that they added. Paragraph 13, certain repairs paid by seller. Any repairs required in the VA certificate of reasonable value, in other words, the appraisal, shall be completed and paid for by the seller prior to closing, provided such repairs do not exceed X amount of dollars in total costs. That'd been in there. In the event, this is what the addition is, in the event the anticipated costs exceed the amount listed below, an itemized estimate shall be provided to all parties from third-party contractor or contractors selected by the seller of the total cost of repairs made to the property. The seller or the buyer shall have the option to pay the excess amount. If the parties do not agree in writing who shall pay the excess amount, then the agreement shall terminate within 3 days of the written notice of the estimated repairs. The other thing that the change to the VA loan contingency exhibit is, you know, for a VA borrower, there are certain costs that the buyer may not pay, the seller must pay. And that list has been in the form. That list has not changed. For example, termite letter, loan closing or settlement fees, document preparation fees, so forth and so on. That's paragraph 14. That had already been in there, but what had previously been in there is a checkbox that you fill out, these costs shall or shall not come out of closing costs. Well, in 2019, they took that option away and basically direct the lender to take those VA mandated costs for a VA borrower that the seller must pay out of a seller's contribution to closing costs, out of that pool of money, so to speak. So the way it reads is, again, it already has that itemized amount, certain fees paid by seller. And then they added the sentence that says, the above referenced costs, which must be paid by the seller, shall first be paid out of the seller's contribution at closing, if any. If the seller's contribution to closing is 0, then the seller shall pay the entire amount of the cost referenced above. So the seller still has to pay all those costs, but it's just directing the lender to take those costs out of that pool of money that is the seller's contribution to closing. The other change they made in the VA loan exhibit has to do with that paragraph, it's paragraph 16, about the public water and public sewer being connected if the local authority requires it. And again, that's been there. You fill in the blank for the dollar amount of that connection cost. What they added is the same. We're seeing the theme that they've added. If those costs come in above the amount that's negotiated, what happens? So in that paragraph 16, it says, as required by VA, both buyer and seller agree that if public water or sewer is required to be connected, it is available at the street and required by the local authority to be connected, it has to be connected for X amount of dollars. Then they added, seller or buyer shall have the option to pay the excess amount if the parties do not agree in writing who shall pay the excess amount, then this agreement shall terminate within 3 days of written notice of the cost to connect the public water or public sewer system to the property, and buyer shall be entitled to full refund of earnest money. The responsible party shall provide at or before closing with a certification from the proper authority that the property is connected to and serviced by the public system. All right. What is it? I don't know if she likes the changes to the financing forms or not. What do you think, Gidgey? All right, one more. Changes to the all cash exhibit, no financing contingency exhibit. So, two changes they made to this one. One is, so it's all cash, but it's not necessarily all cash. It could be just that the buyer is getting a loan, but it is just not, the buyer is just not making the purchase of the new home contingent upon getting the loan. So that has been in there, and that had been discussed all last year. But the changes that they made to the all cash exhibit for 2019 is a couple things. One is they added verbiage in there if a buyer is getting a loan but not from an institutional mortgage. In other words, if they're getting, let's say, a hard money loan, they added that option in there in this all cash exhibit because there were a lot of buyers that were getting hard money to pay for a house, and it was kind of confusing as to what form you would use to make the deal contingent upon that buyer getting that loan from a non-institutional mortgage, and most agents just used that generic contingency exhibit. But so they added that, and what it says is the buyer So what it says is it has that the buyer and the seller negotiate, and it says it has two check boxes. The buyer has, number one, all cash sale. The buyer does have sufficient liquid assets to purchase the property in this transaction for an all cash buyer. And A, reserves the right to pay for all or any portion of the purchase price by obtaining an institutional mortgage secured by a deed to secure debt for the property. So that would be if the seller allows the buyer asserts that I've got all cash or have my hands on liquid assets to pay for the property, but I'm going to finance it if the seller agrees to that through a first institutional mortgage and get a loan. I'm not making the deal contingent on that, but that's how I'm paying for it. Or reserves the right to pay for all or portion of the purchase price by obtaining a non-institutional first mortgage or other loan. So that's the verbiage that accounts for example, a hard money lender. So they added that in there. And then the other thing they did is they took out the option for the parties to use the 8-day unilateral extension based on the lender, even in an all cash, using this exhibit, even if the buyer is getting a loan. So what it states is the buyer shall not have the right to obtain mortgage financing to pay for all or portion of the purchase price of the property. The buyer is not obtaining a loan, therefore the buyer has no right to unilaterally extend the closing date for 8 days for the reasons of mortgage lender delay. So the reason they put that in there is a little bit confusing, but basically if a buyer is purchasing a property but not getting a loan, but not making the whole purchase and sale contract contingent upon them getting a loan, we know there are still potential lender delays, and a lender delay due to no fault of the buyer or the lender not getting out the TRID disclosures 3 days prior to closing is a reason for the parties to use the unilateral 8-day extension. So they've just added that if the buyer and the seller negotiate to allow the buyer to get a loan but not make the deal contingent upon that. They have to get it all cash. I'm not explaining this very well, but basically they took away the 8-day unilateral right to extend the closing based on a lender delay if the parties go binding using an all cash exhibit. So those are the changes to the financing contingency forms. I hope this contract tip helped you out. Stay tuned for more of the changes on the 2019 GAR contract forms. And thank you all so much for watching. This is Dana Sparks, broker of Maximum One Greater Atlanta Realtors, satisfying your needs with service, innovation, and education.